What are target date index funds? A target date index fund is a type of mutual fund that changes its holdings over time to become more conservative as it approaches a predetermined date. Target date index funds are ideal for investors who want a simple, low-cost way to save for retirement. In this video, we will discuss what target date index funds are, how they work, the benefits they offer, and when they may be the right choice for your portfolio. The basics of target date index funds. Target date index funds are a type of investment fund that is designed to automatically shift its asset allocation as the target date approaches. These funds are often used as a retirement savings option, as the target date typically corresponds to the investor's anticipated retirement year. The fund's asset allocation is based on a glide path, which means the allocation shifts gradually over time, becoming more conservative as the target date approaches. For example, a fund with a target date of 2050 may start with a higher allocation of stocks and gradually shift towards bonds and other fixed income investments as the target date gets closer. The fund's performance is also tied to an index, such as the S&P 500 or the Russell 2000. This means the fund's returns are closely linked to the index's performance, but with lower fees than actively managed funds. Target date index funds are often available as part of employer-sponsored retirement plans, such as 401ks. They can also be purchased through brokerage accounts or other investment platforms. While target date index funds offer convenience and diversification, they may not be suitable for every investor. It's important to evaluate your financial situation, risk tolerance, and investment goals before investing in any type of fund. The pros and cons of target date index funds. Like any investment, target date index funds have their own set of pros and cons. Let's take a closer look at each of these. Pros. 1. Diversification. Target date index funds invest in a broad range of asset classes, which means they offer instant diversification. This is especially useful for investors who are not well-versed in investing or who don't have the time to research and manage multiple investments. 2. Automatic rebalancing. Target date index funds automatically adjust the allocation of their assets to maintain their target mix of stocks, bonds, and other assets. This takes the burden of rebalancing off the investor's shoulders. 3. Simplicity. Investing in a target date index fund is relatively straightforward, making it an ideal option for those who don't want to spend time researching and analyzing individual stocks. Cons. 1. Lack of flexibility. Target date index funds have predetermined investment mixes, which may not suit every investor's individual needs. This lack of flexibility can be a drawback for those who want more control over their investment choices. 2. Passive management. Target date index funds are passively managed, meaning that they do not actively seek out investments that may outperform the market. While this can be a pro in terms of keeping fees low, it may not be suitable for investors who want a more hands-on approach to their investments. 3. Higher fees. Target date index funds tend to have higher fees than other index funds due to the additional services offered, such as automatic rebalancing. While these fees may be lower than those charged by actively managed funds, they can still eat into an investor's returns over time. Overall, target date index funds can be a good investment option for those looking for a straightforward and diversified portfolio. However, it's important to consider both the pros and cons before investing and to choose a fund that aligns with your individual investment goals and risk tolerance. How to select the right target date index fund. Choosing the right target date index fund can be a crucial step in achieving your financial goals. Here are some factors to consider when selecting a target date index fund. 1. Understand your investment goals. The first step in selecting the right target date index fund is to understand your investment goals. What are you saving for? What is your risk tolerance? Your investment goals should guide your choice of a target date index fund. 2. Analyze the fund's performance. Analyze the past performance of the target date index fund before investing in it. You can find the performance history of a fund online or through a financial advisor. It's important to remember that past performance doesn't guarantee future returns, but it can help you make an informed decision. 3. Look at the fees. Different target date index funds come with different fees, so it's important to compare and choose the one with the lowest fees. High fees can eat into your returns, reducing the potential growth of your investment over time. 4. Review the asset allocation. Asset allocation is the way a fund distributes its assets across different asset classes, such as stocks, bonds, and cash. The allocation strategy should align with your investment goals and risk tolerance. It's important to review the asset allocation to ensure it aligns with your investment strategy. 5. Choose a reputable provider. Lastly, it's essential to choose a reputable provider. This provider should have a good track record of managing funds and be financially stable. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.